Good morning.
Good morning.
Okay, welcome back to our class. And I suppose that you did make an attempt. That question, which I left with you. Okay, so you're required. A device where the factor offer is financially acceptable to window company. Okay. Here it is. So just check on your workings. Brian, what did you get to be the net cost or the net saving? I presuppose you did the question, Brian.
I started, but I got a bit stuck with the annual fee bit for the current. So,
Okay.
yeah.
Okay. Nafisa.
Sorry, sir, I couldn't join the last part of the last class, so I didn't know what we're supposed to do.
Okay, Sakina.
I got stuck somewhere.
Oh, okay, Sanya.
So I got a net saving of 87,879.
87,879.
Yeah.
Okay, 87,879. Okay, please someone with an attempt. Okay, so let's try to see. Okay, what you did. Where you got stuck. Okay, what you should have done. So in this question, which is the company is looking to improve its working capital management, revenue 26.75 million, all sale on credit, okay, paid within 40 days. Okay, on average, customer taking longer, okay, than this. 1% of the customer, 1% of sales are turns into bad debt. Current investment in Swobo is 4.458. So we can begin there. Okay, our Swobo investment. So this is within our company. Okay, the Swobo investment. Current investment, which was equal to, okay, equal to 4,458,000. Okay, proposal. If the company implement the proposal from the factor, the number of days will reduce to 35 days. Therefore, 35 days out of the number of days on here, that is 60. Okay, we multiply by the sales on credit. Does the sales change? If there's no mention, then assume the sales they don't change. Okay, so therefore they remain at 26.75 million. To give us
2,600,694.
694 that way.
Yeah.
Okay, great. So as you can see, there will be going to be a reduction in the investment from 4.4 to 2.6. Therefore, that will be therefore there will be interest cost saving. Therefore, interest cost saving. Therefore, will be equal to the current financial. How much is it charged per year?
5%.
5%. Yes, 5%. Okay. The company has a cost of shorter finance of 5%. Therefore, 5% we multiply by the decrease from 4,458,000 minus 2,600,694. Annual saving, annual interest cost saving. Therefore, is how much?
92,865.
865. $92,865 for the interest cost saving per year because of the reduction in the investment. Okay. Okay. The finance director's proposal. Okay, that 5 days. Or cutting the bad debt by 70%. Okay, cutting the budget by 70%. Okay, so therefore the next working can be on the bad debt decrease. Okay, current budget. Okay, which is equal to current budget is just 1% of the sales turns into bad debt. So therefore current budget is 1% times 26.75 million. To give us how much?
267,500.
500. We know that if the company implements the proposal, then the bad debt will decrease by 20%. Therefore, reduction in the bad debt, reduction in bad debt expense. Therefore, be equal to,
Actually,
yes, yes.
in the previous question,
Mm,
you said we use the receivables amount.
we use the total amount. When getting, what do you want to get when getting?
Bad debt?
No. That, I think if I remember, that was when getting the advance.
Oh, okay.
Yes, that was when it gets the advance.
The
Don't forget
advance fees.
the advance, yeah, when it gets the advance fee, the amount advance is, for example, 80% of the receivable, the revised account receivable.
Okay.
Yeah, okay. Therefore, reduction in bad debt, okay, therefore will be equal to 20%, okay, 20%. We multiply by the previous expense to 7,500. To give us how much?
187,250.
187,250 together for the decrease in the bad debt expense. Okay, admin cost saving, okay, will be 5,000 per year. The company would advance 80%, so advance. So next is advance fee in quotes. Okay, the amount being advanced is 80% of the revised book value of the receivable. 80%, the revised book value of the receivable is 2.6 million, 2.6 million 694. Yes, 694. That's the amount that is going to be advanced. Okay, and don't forget, as mentioned, maybe I think that was a Kenya who was talking. Okay, the amount that is being advanced is 80%, not of the 2.6 million, not of the 26.75 million. No, the amount that advanced on average basis is equal to 80% of the receivable. Don't forget, receivable is sales is the average sales made on credit. Okay, at a point in time. Okay, if we do a stock take, if you do account valuation of the receivable balances at any point in time during the year, the average that amount of sales that have been exceeded is equal to 2.6 million. Okay, so there you have to be quite careful. Okay, you have to be quite careful. It's not on the entire. The amount that is being advanced, okay, is not 80% of 26.75 million, okay, is 80% of the 2.6 million, the revised account receivable. Okay? That's why you have to be quite careful. Otherwise, anyway, so that's the amount being advanced. And the fee is 7%, okay, which is 2% more, okay, therefore times, therefore, okay, and 7% minus 5%, okay. Therefore, the incremental amount you're paying because of the amount advanced to you. You get how much?
41,611.
611.
Yeah.
Okay, get for 1,611. Therefore, the incremental, the amount you pay over and above what you used to pay because of the advance obtained from the factor. Okay. Then is factor fee. Okay, there'll be factor fee. We told is equal to 0.75% of the sales on credit, which will be 26.75 million. Give us how much?
206.25.
$206.25. Therefore, the amount of fee you pay, and that is it. Well, okay, and that is it. Okay. Simple as that. Wow. Okay, this is really the question. Anyway, let's do it together. So first is bad debt decrease. Don't forget this arrangement is with recourse. So the company continue bearing its bad debt. If it was non-recourse, then the saving, if it was non-recourse, the saving will be equal to 27,500. But since this is recourse, the saving is equal to therefore 87,250, the decrease. Okay, so you have to be quite careful with what arrangement are we dealing with. Okay, therefore bad debt saving. You can begin with savings here. Let's write them savings. So you have bad debt saving, which is 187,250. Yeah, 250. What else? 750. Interest cost saving. Interest cost saving. Interest cost saving, which we got 92,865. 92,865. Admin cost saving, which is 50,000. That is as per the question. And that is it. Okay, that's on the savings. Okay, expenses or cost that comes with you adopting this policy. Factor fee, you pay a fee to the factor for giving the service, 20,000. Okay, 625,000. Then there's advance fee, advance in quote. Don't forget, there's a concern is the increment of bit only. Advance fee, 41,611. Anything else? Hope I've not missed anything else. Advance fee. Yeah, that is it. Net saving. Sorry guys, I think I lost my connection. Can you hear me?
Yes,
Yes.
sir.
Okay, I think I lost my connection for some few seconds there. Okay, so what's the saving per year? Net saving?
87,879.
79. Well, Sanya, you got that's what you got, Sanya, if I remember. Sanya, that's what you got.
Excuse, could you kindly scroll up?
Up. There, or should I scroll down or up? Brian, can you hear me?
Yes, I can hear you.
Okay, so where should I scroll? Up or down?
Down a little. Yes, for the advance fee.
For the advance fee, okay. There it is.
Yeah, would you kindly explain that again? I'm not getting something.
Okay, so here you've been asked that how much the factor advances to 80%, okay, of the sales that you make, okay, and here on average basis,
Yes.
the amount of sale that you make is equal to 2.6 million, which is the receivable. Don't forget, okay. Don't forget what's the receivable. A receivable is a sale made on credit that is outstanding at a point in time. Okay, don't forget that. Okay, the receivable is a sale made on credit that is outstanding at a point in time. Okay, so in theory, you can say that on average basis, okay, if you to go and evaluate, okay, the sale outstanding at a point in time, okay, during the year, the sale will go to 2.6 million. Okay.
What I thought, in the question when it says 80% of the value of the invoices raised, doesn't invoices raised refer to total credit sales?
Okay, and that's where the trick is, okay? Because don't forget, if we are to do 8% of 26.75 million, now what are you telling you, will you be doing? You'll be assuming that the factor is going to give you from month of January all the way to the month of December, okay, is going to be advancing to you, okay, 80% of 26.75 million the entire year. Is that the case?
No.
No, what's happening is that the factor is advancing new money on bits and pieces. Okay, if you make a sale today, they give 80%. You make a sale tomorrow, they give you 80%. You make a sale a month from now, they give you 80%. So therefore, the question is, on average basis, how much sale do you make? You make 2.6 million. Is that clear? Therefore, since you make an average sale of 2.6 million, they give you 80% of it at that point in time throughout the year. Brian, that's clear. Don't forget, let me just repeat. A receivable is a sale that is made on credit that is outstanding at a point in time. Or actually, what's the receivable? Receivable is the average, okay, sale that is outstanding at a point in time, okay, that is made on credit. Yeah, don't forget, this one is simply a sale, okay? It's a sale made that is outstanding. The supplier, the customer are here to pay you, okay? But it's also the average sale, okay, that is made on credit. Is equal to 2.6 million.
Are
So as
we, why are we multiplying it by 7% minus 5%?
because what's the fee? How much does the factor charge you for the amount they advance in you?
7%.
7%. But the question is that even before the factor came over, okay, someone else was financing you. Okay, the bank was giving you money. Okay, don't forget, as I had mentioned, the factor is not advancing a vacuum. It's not that there was no one who was financing you before. Okay, even before the factor came over, someone else was financing you. Okay, who is this? The bank. At what cost?
The bank. 5%.
5%. Therefore, what's the incremental cost? What's the incremental cost? Incremental cost, therefore, is equal to 7 minus 5%.
2%.
Yes, it's 2%.
Okay.
Yeah.
Yes, thanks.
Okay. So, another question?
Sir,
Mm-hmm.
yeah, okay, so suppose in an exam situation, what is the other word that we can use for advance fee? Or if you put advance fee like that, it's fine.
It's fine. Okay, you can call it advance fee. What else can you call it? You can call the incremental cost on the amount advanced. Yeah, you can call it that way. Okay.
Okay.
Yeah.
Okay. And also, for without recourse situation, for the bad debts, the current bad debts, the 267,500,
yes,
is going to be a benefit.
Yes, to the company. Yes, it's a benefit to the company.
Okay.
So the entire of 267,500 become therefore
Okay.
saved. So if for example, if this is without recourse, then here in our final answer we would use 267,500. Okay, this is coming for saving the company, the entire of it.
Okay, fine. Okay, I just wanted to confirm that.
Okay. Yeah, Nafisa, any question? Nafisa,
No, sir.
it's
No,
clear.
sir. Yes.
Okay, it's clear because now I don't think I want to get out of this topic. Okay, and maybe the next time we'll find this question will be the main exam. Okay, I hope it's clear and clear to all of you. Okay, of course, you make a comment when you've done the analysis. Make the comment. Advise with the company where the offer is financially acceptable. Yes, it is. Okay, the factor offer is financially acceptable. Okay, since it yields an annual net saving. You can even mention the amount of 879. Simple as that. Daisy, it's clear. Is Daisy in class? Yes, Daisy is clear. Is it clear from your end? Okay, I suppose that it was clear to all of you. Okay, and that's back to say yes.
Yeah, so I was asking, the question says, advise whether the factors offer is financially acceptable. So are we supposed to do all this working?
Are we supposed to do?
Are we supposed to show all these workings?
The one I've done here. The one I've done here.
Yes.
Yes, you should. All the workings.
Okay, so you have to show all the workings and then comment on it.
Show the workings, then you do the analysis. This analysis here, okay. Then you make a comment here. Yes, you're supposed to do that exactly the way I've done.
Okay.
Yes, exactly the way I've done it.
And then, are we supposed to do this in Excel?
Yes,
like in the main exam?
Yes, this will be in Excel. This is going to be in Excel. But don't forget the way the presentation remains the same. The only difference that, for example, okay, now in Excel you don't need to have you just need to feed in this formula, okay? And the Excel is going to give you this output. Okay, I think I'll show you later on how to do it. But it's simply, there's no difference here. It's not that you don't need to like feed it like the calculator, or just use equals. You know to use Excel, equals 0.75 times 26.5. That is it. Just enter and again to give you this answer. So in Excel, this should be much more easier, of course, definitely very quickly. You can do them in an easier fashion. Okay. However, all the work we have done here, the examiner should see them, even if it's. Let me actually just open my Excel. Okay, just to, for example, present the advance fee. Let me just present how the advance fee should appear in your Excel, for instance. Okay. So give me a second. I open my Excel. Okay, you can see my Excel.
Yes.
Okay. So as in Excel, things should be much more easier. Okay. For instance, I want to do the working for the advance fee. Okay. Or I want to, okay, incremental cost. Okay, incremental cost. Incremental cost on advance fee. On advance. Okay. So and you can see here. Okay, I've made a typo here. Okay, that this is meant to be incremental, but there's no penalty for any typo. Okay, so in case you make a typo in error, there's no any penalty. So you can leave it the way it is. Okay, if you get time, you can come back later on and you can correct it. But there's no any penalty for any typo. The examiner knows you meant incremental cost. Okay, and there's no mark by the way for formatting. Okay, like for example, maybe I want to change from this is Calibri. Okay, the type of the way my writing says. Okay, if you want to use New Times Roman, it's okay. You can do that. Okay, let me change. For instance, I change to New Times Roman. Okay, become more presentable maybe. Okay, change from 11 to 12. Okay, you can do that, but there's no marks for that. So I don't know. You just use what it is. Okay, if you want to make your work more presentable, it's okay, but no extra mark for that, by the way. Okay, so don't spend too much time on trying to don't know color your work here and there. Okay, good tables all over. That links in audit maybe it can in audit maybe there's mark for that, but in FM there's no mark for that. Okay, so just simply go straight to your work. Okay, so don't spend time trying to make your work colorful. No marks for that. Anyway, so if for instance you wanted to show the working for incremental cost, okay, to be equal to 80%, the exact way you've done it, by the way, 80% times 2.62 million, okay, 600. Let me just go back and check to 600, 694, 694, okay. Then times, okay, times, okay, to 7%, okay, 7% minus 5%, okay. That's what the cost, is it? That's what how we got the cost on the advance, the amount advance, isn't it?
Yes.
Yes. So you can see that the working is already there, okay, but you don't have to like do the old way, okay, the calculator way, the way you've done here, okay. So by just pressing enter, it is going to give you the answer, okay, which is what the examiner is going to be checking. He's going to click on your cell and see your formula, okay. Yeah, okay. So here I need to remove the commas, okay. So you can see this is going to be the answer, okay. So by the method, you don't need to, like, for example, have let me show you what I've seen with the student, okay. So by doing this, it's really okay. If the examiner is going to only the examiner's head, okay, double click on it, he's going to see your workings, okay. You're going to see how you were able to arrive at $611, okay. So you don't have to manually do it. Let me show you how I've seen students doing it, okay. Now, students normally do is that they try to do like the old paper way and do it the same way in the Excel. So incremental cost, we call this cost. Okay, they will do. Let me just copy this. Okay, that's what they do it. Okay, to show the working. Look very okay. Okay, you can do that. Okay, then here they come, repeat the same process. Okay, so let me just copy the same process. Okay, equals, and there's it here, equal sign. You can do this, but why would you want to waste time? Don't forget, if you're going to have a lot of workings, then it means that you want, as if you want to have the paper format, okay, the paper way of doing things, okay, to appear in the Excel. You don't need to do that, okay. By simply doing by just doing it in one step, okay, like in this cell A2, that's how it should be done, okay. So you don't have to do this odd way, okay, where you want to do the cost, you show how you got the answer. This is Excel. The examiner can see the working on that particular on cell C3. By double clicking on it, he can tell that how you're able to get 41,000. Okay, so don't do this way. Don't do this. Okay, let me just don't. You don't have to do this. Let me just color it here. Okay, don't do this. Okay, it's just going to waste your time, and there's no an extra mark for that. Okay, the examiner is going to click on the cell and see the formula, okay, and it's going to give marks based on the formula that the examiner sees on that particular cell. So don't waste time to present like the old way, okay, don't do that. Here?
Yes,
Sorry?
and is cell referencing allowed?
Sorry?
Cell referencing?
Sorry? Yes, you can do that. For example, if I want to, maybe here, what could be this? Maybe the solution. Let me just send the solution here. I want to present final solution. So I'll begin with savings, for example, a cost. Let me just put cost here. So I want to do cost here. Okay. So one of the costs I want to refer to is the incremental. So I can just call equals of that. I've just made a reference to the cell. That's what you mean.
Yes, and even in
The solution, yes. Yes,
solution.
I make the reference, and that is it. Yes, you can do that for sure.
Okay.
Yeah, use Excel to the maximum capacity. It can go. Okay, use it to your own advantage. That's what I want to mean. Okay. However, all your workings, okay, the one you've done here. Let me just go back. Okay, all the workings you've done in the paper way in quotes. Okay, so all these working you've done here. Okay, they need to appear on that Excel. Okay, they may appear different. Okay. For example, in the budget expense, okay, let me just present in the budget expense, okay, I can do it in one go, okay, I don't have to do current, the reduction in the budget, I can just do it in one go, okay. For instance, let's go to the cell, to the Excel again. Okay, I want to present the budget expense here, for example, okay, decrease in budget, okay, so budget reduction, okay, will be equal to. So first determine what's the current budget. The current budget is equal to 1%, okay, of the current sales, 2750, 123, okay, that's the current budget. Then you told that the decrease will be 70%, therefore the saving will be equal to times 70%. So you see, I'm going to do my working in one go, okay? I don't have to do the current budget, okay? Like the way you have to do in the paper way, which used to be the old way of doing question. But now, since it is Excel, okay, you just simply do it in one go, okay? And that is it. Okay, so the examiner is going to click on the cell and see how did you obtain that answer. As much as possible, by the way, avoid using calculator when doing this Excel, okay, presentations. Avoid using a calculator as much as possible, because you're going to forget the workings you did in the calculator. You forget to reflect the same in the Excel, and okay, the examiner is going to mark what appears on the Excel. Okay, is that clear?
Yes.
Okay.
Thank you.
Okay.
Excuse me, sir.
Yes, sure.
I just wanted to ask, in the section C, are there specific topics that are gonna appear?
Don't forget, as I normally mentioned, for example, working capital could be there. Okay, we shall mention along the way, but working capital will either be section B or section C. Okay, but it will have to be there in one of those two sections. But I think with time, I think you'll also be able to experience what are the common type of questions to be tested in section C. Yeah, one of them, for example, is working capital. Okay, most likely, if it doesn't appear in section C, okay, which most likely it appears, okay, it will appear in section B. Yes, we shall mention them along the way as we go through. Clear?
Thank you.
Okay.
Yes.
Okay. Yeah, so that is on how to manage account receivable. How to manage the account receivable. Okay. Now let's discuss the next component of working capital, which in this case is cash. Okay, so cash management. Okay, we discuss on cash management. Okay. Any question on the receivable before we proceed to cash management? Okay. So when it comes to cash management, okay, the same objective that we had before, okay, will also apply here, okay, that as a company, you want to achieve the two objectives, the two core objectives, maintain liquidity. At the same time, you also want to make profit, okay, you maintain liquidity, but at the same time, you do want to make profit, okay. When it comes to cash, don't forget, as we mentioned, that cash generally, if you have cash in it hard format, okay, then generally it earns for you nothing. Okay, there is no any interest be earning. Okay, yes, you're going to be very liquid. Okay, however, the amount of return you make quite minimal. You don't make any return in short. Okay, you don't make any return. Okay, what that implies is that therefore, as a company, you have to consider. Okay. We want to remain liquid, that's true. However, we also want to make positive returns from the cash investment we have. Okay, so you want to make profit, okay, by investing the first cash, for example, elsewhere, as well as also remain liquid. You want to also remain solvent as a company. Okay. Now, in that case, therefore, when it comes to cash management, we're going to be discussing what models, okay, can we use that are going to help us in getting to know in quote the right amount of cash. Okay, you don't want to have more cash than all you need. Okay, neither do you want to have a case where there's cash shortages. Okay, you don't have excessive cash. Okay, neither do you want to have cash deficiency. Okay, what is the exact in quote the right amount of cash as a company we ought to be holding? Okay. So here discuss a number of models that can use to help us in getting to know the right amount of cash. Okay, we should discuss two models. Okay, the Miller or model. Okay, as well as the Balmore model. Okay, so we discuss this model in cash management. Okay, we can also use another tool. Okay, which I think you may have done it already. Okay, what we call the cash flow forecast. Okay, the use of cash flow forecast. Okay, cash flow forecast to help us in cash management. Okay, that's again the first tool. Okay, not a model, it's a tool. Okay, that can help us in determining the right amount of cash the company ought to be having. Okay. Anyway, to begin with, why do we need cash? Okay, why does the company hold cash? Why do they need cash? Okay. One of them is definitely so that they can be able to pay for the transaction. Okay, so if you have suppliers money due today, okay, can you be able to pay them? Okay, you can only be able to pay your suppliers if you have the money today. Okay? If you have the money, you have money at hand. Okay, otherwise then you can't pay for them. Okay, it's to pay for the transactions that are maturing. Okay, to pay for the day-to-day expenses. Okay, definitely you also want to keep cash for the case of what we call precautionary motive. Okay, just in case the cash demand is going to exceed what was our anticipated amount, okay, can we be able to pay for them? Okay, we call precautionary motive of cash. Okay, you want to, if for instance, okay, you had planned, okay, that within the next 1 day the amount of expenditure you'll be having is, let's say, 2 million. Okay, in the next a month is 2 million. What if there's going to be more demand of cash than what you have planned for? Okay, can you be able to pay for the extra expenditure over and above the plan? Okay, over and above the budget. Okay, so sometimes the company therefore they do keep, okay, what we call some cash, okay, to take care of the precautionary to take care of that unforeseen demand of cash. Okay, that unforeseen demand of cash, of course, the precautionary motive of cash. Okay, and of course, you have the speculative motive of cash. Okay, so this is to take advantage of market opportunities. Okay, that's the why you want to keep. You may want to keep some excess cash. Okay, you don't want to invest all your asset, all your cash in long-term assets. Okay, in buildings. Okay, in vehicles. Okay, because sometimes you can have a case where you want to have some in quote freedom. Okay, of being able to make decisions, because once you do tie down your cash in long-term assets, then to convert them back to cash, it is going to take some time. Okay. For instance, to convert a parcel of land to cash, okay, it is not going to take 1 day. Okay, it's going to take a length of time. It's going to take months. Okay, for instance, okay, which implies therefore it is going to be, it's going to be illiquid. Okay, that's the term to use. It's going to be very liquid. Okay, and therefore the case is that you want to ensure that you can keep cash if, for example, the market or if the government of Kenya, okay, want to issue a very lucrative, okay, treasury bills and bonds, okay, can you be able to invest those bills and bonds? You can only do so in case you have cash, okay. In case you do have cash, okay. That's what therefore I'm saying here. You want to keep cash for the sake of to speculate on cash, okay, to take advantage of the market opportunities that the market can avail to you, okay. That's called the reason of holding cash. Okay, those three. And this was a question that we examined in the past has asked. Okay, why do you hold cash? Okay, I think you shall just go through it and you shall see. You shall see it. Okay. Now, as mentioned, one of the tools that we use when it comes to cash management, okay, is called the use of the cash flow forecast. Okay. Now, cash flow forecast, okay, we want to determine, okay, in the next 3 months, the next 4 months, okay, in the next maybe a few days, okay, weeks, okay, what is going to be the need of cash for the company and what is going to be the cash source of the company. Okay, you want to quantify in the next few days, the next few months, okay, what is the total cash consumption, for example, okay, what is the total cash you're going to be generating, okay. The idea or the reason why you want to do this forecast, okay, is just in case there's going to be some months, okay, for example, where we have cash shortages, okay, maybe in the month of February, in the month of December, okay, the cash we need is 10 million. The cash we will be generating is 50, will be generating is equal to 8 million, okay. So the need of cash in that month, 10 million, is more than what you have, 8 million, okay. Therefore, what do we do to take care of the deficiency? Okay, you are able to plan in advance. Okay, it's more of a planning tool. Okay, maybe there's a month of December. Okay, for retailers. Okay, that's when the peak season is. Okay, where there are more purchases and there are more purchases. Okay, now in that month when you have, for example, the amount of cash you're going to be generating is, let's say, 50 million. Okay, the amount of cash you'll be requiring is only 10 million. So you have an excess cash of 40 million. Now you can plan in advance, okay? You as a treasury manager, okay, for the company, okay? What do you do with this excess of 40 million you have, okay? You plan, maybe invest, maybe just have it in cash form because the next month of January, the demand, you'll be having cash shortages. So have it in cash form, therefore, okay? Either way, the cash forecast is more of cash planning tool, okay? Where you do quantify the cash inflows and the cash outflows, okay, for the business within a given time period, okay. Clear? Okay, Sakina, it's clear?
Yes.
Okay. Now, as I mentioned, when it comes to preparing the cash flow forecast, okay, you want to determine where the company, first, as I mentioned, is the cash inflow sources, okay. Determine, okay, where is the money coming from, okay. Where does the company obtain its cash from, okay, from sale of property, from sale of commodities that they're involved in, from issue of shares, okay, from bank loans, okay. In short, determine all the cash inflow sources, okay? So the first idea, okay, determine where is the money coming from. And as mentioned, you don't make a distinction of where the money is from long-term source or it's from a short-term source. It's from a capital source or it's from a revenue source, okay? For example, from the amount received from the issue of shares, okay, this is a long-term finance source. It's a capital in nature source, okay? It's a capital, is a source of cash, okay, that is a capital in nature. However, we don't make that distinction, okay? It's still money into the business, okay? If, for example, it's going to have amount received from the sale of inventory, okay, you are a retailer, okay, you sell merchandise, okay, the amount received from the sale of the merchandise you're involved in, that's a revenue source, is a revenue source of money, okay. But now it doesn't mean that you're not going to quantify it. You quantify it, okay. In short, what I'm trying to pass across here is that at the end of the day, when it comes to determining the cash flow sources, okay, you don't make a distinction whether it came from a revenue source or a capital source, okay, short term or long term. We don't make that distinction, okay. Amount received from sale of property is still cash inflow, okay. Amount received from sale of inventory, it is still cash inflow, okay. So you quantify them either way, okay. And of course, the same applies when it comes to the cash outflows, okay. we don't make a distinction where the money is for the consumption, okay, or the money was used to buy long-term assets or short-term assets. We don't make that distinction, okay. Whether money, if you're going to use money to buy property, to buy a motor vehicle, for example, okay, it doesn't matter, okay. It is money out of the business. It's cash outflow, okay. If you're going to use money to pay your employees, it is still money out of the business, okay. So we don't make that distinction where the money comes from. Revenue source, the cash consumer is either revenue or capital in nature. We don't make that distinction, okay. It's money in the business, it's money out of the business, either way, okay. Or accounts preparing, okay, one of the key concerns, okay, that normally find with students when it comes to preparing the cash flow forecast is that you forget that you're preparing this forecast, okay, on cash basis, okay, not on accruals basis, okay. What's accruals basis, Brian? Brian, what's accruals basis?
Accruals basis means you let your fees and bills accumulate, then you settle them later.
Hey, Brian, are you sure about that? No, don't forget. Accruals basis, don't forget. Accruals basis of preparing financial statement is that if, for instance, you have an expense, okay, we make the recognition of the expense, okay, in the books of the company, okay, when we incur it, okay, not when you pay for it, okay. You make the recognition in the books of the company when you do incur that expense, not when you pay the expense, okay. When it comes to revenue, okay, you make the recognition of the revenue when you earn, okay, not when you receive the cash. It's when you earn the revenue, okay, not when you receive the cash. For instance, you can make sale this month, okay, of items on credit, okay. It does not mean that you're going to recognize the amount when you get the cash. No, you make the recognition of the revenue this month when you make the sale, okay. If you receive the money to next month, that's going to receive you. That is going to be received next month. But when it comes to recognition of the revenue, okay, you recognize it for when you earn it, okay. Now, when it comes to preparing the cash flow forecast, we use a cash basis, okay. Let me use that same example of the sales on credit, okay. You make a sale this month, okay, but receive cash next month. When it comes to preparing the forecast, we don't recognize the potential cash. It's when we actually receive the cash. The recognition, therefore, will appear next month, okay, when you prepare the cash forecast. Not this month, okay, when you make the sale, but when you receive the cash from the sale, okay. The same applies to the case of expenses, okay. If you have employees, okay, you pay them 1 month later, okay, assume that happened, okay. You don't recognize the wages this month, okay, because you have not yet paid for them, okay. But you recognize that wage next month when you actually pay the employee, when the money moves out of the business, okay. We prepare on cash basis, okay. That's what you are quite careful when preparing this forecast, okay. That's if once you get to know that, then it becomes very easy to prepare the forecast, okay. Clear, Daisy?
It's clear.
Okay, great.
Sir, I have a question.
Ask.
How likely is it for the examiner to ask us to prepare a whole cash flow forecast?
Yes, that's not in the past. A number of, I think, okay, I've seen at least how many times? I think 3 times. Yeah, you can be asked to do that.
Oh, okay.
But if it comes to be a section C question, to be a section C question, it can be.
Yeah.
It cannot be.
That's right.
Yeah.
Okay.
Okay, so generally, okay, this can be just an example of how you prepare the cash flow forecast, okay? So here, as I mentioned, you recognize all the cash inflow, okay? Let me just use my pen. So here, you recognize the cash inflow, okay? All of them, whether from revenue source or from capital source, okay? Then here, you recognize all the cash outflows, okay? For instance, this is revenue, this is capital in nature, this is payment, this is revenue, this is capital in nature, capital in nature, revenue. Okay, so you don't make a distinction of whether the source or whether there's cash outflow or the inflow is from capital or revenue source. Okay, and of course you make therefore what there's a surplus for the month. Okay, therefore all the inflow minus all the outflows to get therefore the surplus for the month. Then what was the balance beginning of the month? Okay, to give therefore the balance end of the month. Okay, and of course for the closing balance for January is the opening balance for the month of February, and the closing balance for the month of February is opening balance for the month of March. Okay, and that's how you prepare the cash flow forecast. Okay, and it take me 1 minute to go through it. Okay.
Excuse me, sir.
Yes, yes.
I just wanted to say, could I talk to you at the end of the class as I have a problem with my account?
Yeah, sure.
Okay, thank you.
Okay. Okay, I suppose you have gone through it. Okay, because I want us to prepare one. Okay, I want us to prepare a cash flow forecast. Okay, from the past paper. Okay, you've gone through it. Okay, because you shall follow a similar format. Okay, when preparing the cash forecast. Okay, so let me get it. Yeah, there's a time actually. It should be like maybe 1 or 2 years ago. The examiner asked the students to prepare cash flow forecast. Let me get it. It's very easy in case you understand you don't use accruals basis, you don't mix up, okay? Because that's where you can make mistake. You mix up between accruals and the cash basis. Once you get a hold of that, then it's a very easy. They're free marks actually. But once you mix them up, then you end up with the wrong answer. That one. It isn't a question. It's not a very good question. But in case we be asked about to prepare one, then quite likely to be a section C question. It can also be section B, by the way, but I highly doubt it. So most likely to be a section C type of question.
Sir?
Yes.
Could you please repeat the difference between accruals and cash basis?
Okay, accruals basis, don't forget when it comes to, I'll give you the example of revenue, okay? That when it comes to revenue, you make the calculation or the company is going to recognize the revenue in their books once they earn it, not when they receive the cash, okay? And I gave the example of sales made on credit, okay? If a sale is made this month on credit, okay, then the company is going to recognize the sale in their book this month, okay? In their books this month. However, when it comes to the cash basis, okay, you're going to recognize that sale. You're going to recognize that sale next month when you receive the cash. Okay, that's the case of revenues. Okay, when it comes to the expense, you, under the case of the accruals basis, okay, the expense is going to be recognized in the books of the company once the company incurs the expense, okay, once the company incurs that expense, okay, if they are for example, it's about wages, okay, when did the employee provide the service? This month. Therefore, in the books of the company, this month, you make a condition of the revenue. But when it comes to the cash basis, it's when you pay the employee. Okay? If you're going to pay them 2 months later, then you may recognize in the company maybe cash flow forecast the month when you pay the employee, not when they did provide the service. Okay, do you get it? That's Anya.
Yes, I get it. So basically, accruals is you recognize it immediately when you get the order or something like that. You don't wait for the cash to come in.
Yes, yes. It's not when you get the order, when you fulfill the obligations. Okay, you done this. You remember you did it in law. You remember those the seller, the rights. You remember anyway. It's when you are able to you provide. Okay, this if for example it's about the service. Okay, let's say about let me get a small example of Safaricom. Okay, now for the case of Safaricom, for instance, okay, they are going to recognize the revenue. Okay, once they provide the service to you. If for example it's about calling. Okay, they're going to recognize the revenue from the sale. If you do load a crate of let's say 100 bob. Okay. They're going to recognize in their book once they provide you the service with, once you make the call, okay, or once you use the data, okay. But they should not do that before they provide the service to you, okay. Well, they have yet to fulfill their part of the bargain, okay. So it's when the company fulfill its part of the bargain, okay. That's when therefore they make a recognition of the revenue, okay. Actually, having said that, if for example the customer pays in advance, okay, if the customer pays in advance, okay, like this is Safaricom, where you pay before the Safaricom give you the service, okay, now the revenues is going to be recognized. Maybe if you're going to road today, you're going to call tomorrow. In books of the Safaricom today, okay, the credit you have loaded is a liability to the company. Don't forget, okay. However, the Safaricom has the cash, okay. Therefore, on the side of Safaricom, the cash is recognized today, even though they're yet to provide the service. Okay, because service is again provided maybe tomorrow once you do make the call. Okay, that's just an example of trying to give hope. Is making a base things clearer. Okay.
Okay, Sai, I understood. Thank you.
Okay. Okay. Where is that question now? Mm-hmm. So the question asks us to get a balances, bank balance by this should be somewhere here. Yes, it is. This is page 55. Page 55. A company called Fleet Company. Page 55. A company called Fleet Company. Okay, so go through it in the next 2 minutes. Then we discuss together. Fleet Company, page 55. Okay, I suppose that you've gone through the question. Okay. Okay, so let's prepare the forecast together. Let me get my act together. Okay, so in this example, we are meant to prepare or to determine what will be the cash balances out of each of the 3 months. Okay, and the 3 months start in January, I guess. So the 3 months is January, February, and March. Okay, so we need to quantify the cash inflows and all the cash outflows. Note 1, selling price is 800. And this is going to increase by 5% in the month of February. Sales are on 1 month credit. Okay, so if you make a sale in the month of January, you receive it in the month of February. Okay, so you can begin here. This Fleet Company. Okay, so I'll represent 1 as January, 2 as February, and 3 as March. Okay, so this is about the cash inflow. Is when you get the money. Okay, so in the month of January, you receive cash for the sale made in the month of
December.
December. Great. Okay, therefore in December, the sale made was 1,200 at a price of 800. Give us 960,000.
960,000.
Okay. In the month of February, you receive for the sale made in the month of January.
January.
So 50 times 800 give us 1 million. Okay. Then in March, you receive for the sale made the previous month, the month of February. Okay, 1,300. Don't forget the month of February, the price increased by 5%. 800 times 1.05. And you get how much?
1,092,000.
1,092,000. And therefore, the cash to be received. Okay. Don't forget here, there's a 5% increase. Okay, for the sale of the price as at the month of February. Clear? Question? Okay, that's in this is on this is amount received from sales. Okay, this is amount received from sales. Okay, that is note 1. Okay, note 2. Okay, note 2. Production of goods for sale takes place 1 month before the sale. Now, for the sale that was made in the month of December, when was it? When was the good the production? When was the goods produced?
In November.
November. Okay, great. Therefore, for the sale that was made in the month of February, the sale made in the month of February, when was it produced?
January.
In January. Okay, that's what you need to take note of. Okay, that's note 2. Note 3. Each unit produced requires 2 units of raw material. 2 units costing 200 per unit. Okay, raw material purchases are on 1 month credit. They are on 1 month credit. Which means therefore, production done in the month of January. Okay, when was it paid for?
February.
February, yes, the month of February. So here is raw material payment for raw material purchases. Okay, raw material purchases. For January, February, March. Okay. Now, therefore, which means therefore the production done in the month of January, the sale made in the month of January, 1250, they were produced in the month of December, paid for in the month of January, isn't it? Okay, which means therefore payment for material, therefore in the month of January, be 1250 times 400, which is 200 times 2 times 2. Okay, is that clear?
But 1250 is the sales.
Okay,
For
yes.
January. So production is 1200.
The sale made in the month of January is how much?
What?
The sale made in the month of January. When was it produced?
It was produced in December.
When was it paid for?
It was paid for in January.
Yes.
So how does it appear in terms of when it was paid for? In terms of the raw material purchases? What was?
Let's think through. The sale made in the month of January, it's how much?
It's 1250.
When was it? When were they produced?
They were produced in December.
When did you pay for them?
I paid for it in January.
Yes, so this is that's why this is January.
Oh yeah. So the 1250 has to appear in January.
Okay. Yes, it will appear in January. Okay. The same applies February 1300 times 400. March 1400 times 400. Give us 500.
Yeah.
520. I'm just guessing, not sure. And
520, yes.
And 560.
Yes.
Okay, that's payment for material purchases. Okay.
Raw material, yes.
So note 2 and note 3. Okay. Note 4. Variable overheads and wages equal to $100 per unit are incurred during production and paid for in the month of production. Okay, so here is variable overhead and wages. Variable overheads and wages. Okay, variable overhead and wages. Okay, So January, February, March. Okay. For the sale made in the month of February, sale made in the month of February, when were they produced?
January.
When did you pay for the wages?
In January.
In January. Okay, therefore 1,300 times $100. Therefore 1,400 times $100, and therefore 1,500 times $100. 130, okay, 140, and you have 150. Clear?
Yes.
Okay, that's for note 4. And that is it. Because no working for note 5, no working for 6. That is it. Okay. You know the workings. Simple as that, by the way. Okay. So here you can have the 4 final. We need to get the cash balance for each of the month. So January, I represent as 1, February, and March. Okay. So you can begin the cash receipts or cash inflow. First cash inflow will be from sales, which we done working for that already. So working for sale, 960, 1 million, and 1092. Any other cash inflow? Yes, note 6. A long-term loan of 3,000 will be received in the month of March. Okay, so long-term, this is loan, cash received from loan. Okay, received in the month of March equal to 300,000.
300,000.
And we don't have the cash inflow. Therefore, 960, 1 million, and you have 1392.
I have a question. Is the balance that is expected, that is the opening cash balance in January, not part of the cash?
Receipts. Okay, well, you can put it as part of the cash receipts, but I prefer to put it as an opening cash balance. Okay, just once we done the analysis, we down there should have the open cash balance.
Okay.
Okay, I'll show you. Okay. Okay, so that's the kind of the cash receipts. Okay, then you have cash payments. You can have here cash payments. Okay, cash payments begin with raw material. Raw materials, and the raw materials, we are done working for that. Raw material, 500, 520, 560. So 500 cash outflow, 520, 560. Payment for variable overhead and wages. Okay, let me just call it wages. We got 130, 140, 150. So 130, 140, and 150. Any other payment you're making? They're note 7. A machine costing 400 is getting paid for in the month of March. So machine, okay, 400. And that is it. So here I can say net cash flow. Okay, we call the net cash flow for the month will be equal to the inflow minus outflow. Okay, what do you get for each of the month? 960 minus 630, and you get 330. Inflow minus outflow, 960 minus 630, 330. In the month of February, it's 1 million minus 660 to give us 340. In the month of March, 1392 minus the sum of those three, 560 plus 400, that's 960. 960 plus 150 to give us, what do you get?
28,200. Sorry, 282.
282. Okay, 282. Okay, then cash balance brought forward. Cash balance brought forward. Okay, because here in the month of January, we can put the 40,000 now here. Okay, Daisy.
Yeah.
So 40,000 cash inflow. Okay, 40,000. Then you can have cash balance carried down is equal to 370. Okay, this can have the opening balance for the next month. Therefore, 370. And you have what do you have? 710. You have 710 here. Opening balance next month, 710. And get 992. Clear?
Yeah.
So what you have to be careful is simply get to know when the amount is going to be received, when the amount is going to be paid for. Okay, that's what you have to be careful. You're using the cash basis, not the accruals basis. Okay, and of course, as you can see, the examiner is going to be presenting this on the accruals basis. Okay, so it's upon you to be careful. You don't use what the examiner is presenting. Okay, use when the cash, for example, is being received, when the company is paid for the revenue. Okay, we use cash basis, not the accruals basis. Clear?
Yes.
Okay, great. Simple as that. That's why therefore you prepare therefore you do prepare the cash basis. You do prepare the cash flow forecast. Any question?
Excuse me, sir.
Yes, sure.
Can we answer the C part of the question?
Part C. What's the C part? Yes. Part B. Is it part B? Is it part
C.
C. No, actually, I want you to do this part that I want you first to answer on current ratio. I think if I remember. Yes, first answer part. Okay, let's answer part C, then you do part B. Okay, because I want you to get the current ratio. Now, part C, since the company expects to have a short-term cash surplus during a 3-month period, discuss whether this should be invested. Now, that is a part we have not discussed yet. We shall discuss it alone. Okay. Okay, but I think I still mention it. Okay, because it's more towards now. Where do we, if now since let's answer it. Since we do have this is a short-term cash surplus, where do you invest money? Should you invest in shares? Should you invest in T-bills? Where is the best investment? Nafisa.
Yes, sir.
Mm-hmm.
Could you please repeat the question?
Part C of the question. So I was asking, if you have short-term cash surplus, okay, like in this example, where should we invest that excess cash? In shares, in treasury bills? Where should we invest that money? Nafisa?
Shares?
Mm-hmm. Why shares?
Because that's
And let me answer the question. Don't forget, here, first of all, this is a short-term cash surplus. Now, this is short-term. Where is this? Where's the term? This is a short-term cash surplus here, okay? Which means, therefore, if you have to invest, if, for example, the next 1 month, so this month you have surplus cash, the next 1 month there's cash deficiency. Where are you going to obtain this money from? So the best thing, since this is a short-term cash surplus, invest in short-term assets. Okay, you can't invest in long-term assets. You can't invest in shares. Okay, what if the market is illiquid? Okay, it might take longer for you to dispose of those shares to convert them back to cash. Okay, so it is more prudent. Okay, it is more prudent for the company to invest in short-term maturing assets. Okay, invest in T-bills, invest in money market instruments. Okay. So since this is a short-term cash surplus, invest in short-term maturing assets. okay? And therefore, invest in, for example, in T-bills, invest in commercial papers, okay? So invest in those assets, simply in the money market instruments, okay? Don't invest in, you may want to avoid investing in shares, okay? Just in case they may take longer, okay, to even be processed, okay? So you may want to avoid that as much as possible, okay? Okay? Daisy?
Yeah, I get it, sir.
Yeah, so since it's short term, invest in short term assets, okay? It's for the sake of the ease of converting them back to cash.
Liquidating.
Yeah, liquidate the short. Be able to convert them, just liquidate them, okay? Now I want you to attempt part B. I want you to attempt part B. Okay, so I want you to attempt part B. Okay, maybe the next 2 minutes. Okay, so attempt part B.
So
Sakina?
for part C, you should decline, yeah?
Yeah, decline, yes.
Okay.
The company should not invest in shares in case, just in case they're going to be illiquid. Okay, the idea is that since these short-term assets, these short-term cash surplus, they should be invested in short-term maturing obligations, also short maturing assets, not the long-term ones, not the illiquid ones.
Okay.
Okay, for 3 marks, don't forget. Okay, at least 3 concrete, solid answer. Okay, points that is. So part B, attempt to do part B. Brian. Hey, Brian's not in class. Daisy, what do you have? Daisy?
Yes, sir. Not yet. I'm not yet finished.
Not yet, okay. Nafisa, what do you have?
I didn't get an answer.
Oh, you didn't get an answer.
Yeah.
Hey, okay. Sakina, what do you have?
For January, I have 2.63.
I don't know. Okay, all we want is at the end of March. Wow, okay. Wait, so give us the end of March.
3.61.
3.61.
Yeah.
3.61. Sanya, what do you have?
So I got 4.
Exactly 4 times.
4.2.
Okay, 4.2. Okay, 4.2. Okay, I guess we can attempt to do it together. Now, so in this question, no, we want to get the current ratio end of the month 3. Okay, so let's attempt to do it together. Okay, my working area is this. Okay, so first we have cash flow. The current ratio, let me just remind you, current ratio is given as current assets divided by current liabilities. Okay, current assets, we have one is cash. We have it here already, 992. Okay, so cash is 992,000. Next, we can get receivable. So receivable, we have been told that the sale are on 1 month credit, isn't it? That's what we've been told. Okay, let me just go to the question again. Yes, not one. The sale are on 1 month credit, okay, which imply therefore the sale made in the month of March 1400, they are not yet paid for by the end of the month of March. So therefore they're receivable, okay? Therefore 1400 times 800 times 1.05. So the price have increased by 5%. Therefore the receivable therefore end of the month of March.
1,176,000.
126,000. Okay. Therefore that's the receivable. Therefore end of the month of March. Okay. There's no raw material, okay? There's no raw material inventory is held, so therefore no material. However, we have finished goods. Are they finished goods? Work in progress. Let me call them work in progress. Okay, finished good, work in progress. Okay, just call it the finished goods. Now, for the month of, for the sale made in the month of April, the 1500, when were they produced?
In March.
They're produced in March. Therefore, by the end of the month of March, they're still, the company has them. They have the company, they are finished goods, okay? They're produced a month in advance, okay? Therefore, this 1500 units, they were produced in the month of March, okay? They have their part and parcel of the closing inventory, okay? What's the value or the cost per item? Okay, because these are 1500 units. The cost per item, first you have raw material, which is 400, isn't it? Remember, the 400 raw material.
Yeah, the cost of production.
Yes, 400, okay? Then we do have wages, okay? Isn't it? And the wages,
yes.
Okay, they are paid for in the month of production. So for the wages, therefore, they were paid for in the month of March. So therefore, they're not outstanding by the end of the month. However, the value is still there, okay? So therefore, plus the 400, the 100. So you are therefore 750, isn't it?
Yeah.
Multiply 750, confirm. Therefore, get 750 therefore to be the value of the finished good. Okay, cash plus receivable plus finished good. Total current assets therefore is how much? Total current assets therefore is how much? 992 plus 1160, 11, that's 76 plus 750. 2 million.
928.
928,000. Okay, because therefore the current assets, current liability. Okay, what do we have? We have materials, and then you can have raw material. Suppliers with these payables, and we just call it payable. That's much better. Payables. We have two suppliers for raw material.
So I got 2,918,000.
19. Wow.
Yeah, me too.
18.
18.
918.
Oh, not 28.
Yeah.
18. Okay, thank you. Therefore, payables. Okay, that's the part of current liability. We've been told that the raw materials, they are paid for, they are on 1 month credit. Okay, and we say that for the sales made in the month of April, they were produced for in the month of March. Okay, for the sale made in the month of April, they produced in the month of March. And the material were bought in the month of March, but paid for in the month of April. Therefore, by the end of the month of March, they are outstanding. They are not to be paid for. They're part of the payables, therefore. 1,500 times 400. Is that clear? Okay. I hope silence means that you agree. It's clear.
Yeah, it's clear.
Okay. Therefore, the payables, the amount outstanding to be paid to suppliers to be equal to, therefore, 600,000. For the case of the variables, by the end of the month, they're being paid for the same month. Okay. So therefore, they're not part of the payables. And that is it. Therefore, current ratio is current asset to 918,000 divided by current liability, which is equal to 600,000 to give us 4
So,
yes.
there was a machine bought. Isn't that part of the liabilities?
Machine is an asset.
Sorry, no. Yeah, it's an asset.
So the machine is an asset, yes.
Do we include it? Oh yeah, it's part of it. It's okay.
Okay. So you get 4.86.
4.86.
4.86 times 4.86 times. Sanya, where did you make the mistake?
So I just made a silly mistake in calculations.
Oh, okay.
Yeah.
There's someone else who had 4 point something. Is this Akina?
Yeah.
Where did you make the mistake?
I did not include finished inventory. Finished
Okay.
goods inventory. Yeah.
Okay. Yeah, there by there, you say this is where you're gonna make mistake. Okay. Yeah, because you forget that you have finished goods that are going to be sold the next month. Yeah, there you can make a mistake for sure. Okay, and that is it. Question? Okay, if there's no question, then fair enough. We meet tomorrow. We discuss on the two models on cash management, the Baumol model and the Miller-Orr model. Okay, we discuss. I hope by the end of tomorrow we'll be done with working capital. Okay, working capital management. As I mentioned, there'll be a question in the exam, either part B or part C, but there'll be a question on working capital. So I hope that you've been able to get a good grip of the concepts. Okay, fair enough. Then we meet tomorrow then from 11, I guess from 11.